In the final weeks of 2001, as Enron's stock chart collapsed into a near-vertical freefall, one question echoed across trading floors and newsrooms alike. How could a company once celebrated as the most innovative in America unravel at such extraordinary speed, leaving behind a trail of disbelief that stretched from Wall Street to Washington? The paradox was unsettling. A corporation widely praised for its transparency had been hiding one of the most opaque financial architectures in modern history. And as investigators began peeling back its layers, the truth became clear. This was not a sudden catastrophe. It was the final stage of a long-running structural failure that had remained unseen, unchallenged, and uncorrected. Enron began in 1985 as a natural gas pipeline company, created through a merger guided by Kenneth Lay. Over the next decade and a half, it reinvented itself into an energy trading giant. Analysts praised its ambition. Commentators admired its willingness to transform energy from a physical commodity into a tradable financial instrument. By the late 1990s, Enron ranked among the largest corporations in the United States. It reported extraordinary revenue growth year after year. Executives appeared regularly on magazine covers. Boards admired its strategy. And its auditor, Arthur Andersen, carried a reputation as one of the most formidable accounting firms on the planet. Yet beneath this image of strength and innovation lay a corporate structure increasingly reliant on aggressive financial engineering. The numbers were impressive, but the mechanisms generating those numbers were becoming harder to trace. In the year 2000 alone, the company reported more than $100 billion in revenue, while its underlying cash generation was nowhere near that scale. At the center of Enron's approach were special-purpose entities, legally separate partnerships designed to move debt off the company's balance sheet. In theory, these structures could transfer risk and create financial flexibility. In practice, many were used to disguise liabilities and inflate asset values, creating the appearance of stability where little existed. The company also relied heavily on mark-to-market accounting. Instead of recognizing profits gradually over the life of long-term energy contracts, Enron recorded their estimated future value on the day the contracts were signed. This produced earnings that appeared consistently strong, but were disconnected from the company's true economic performance. It was the equivalent of claiming decades of profit at once, based on assumptions that might never materialize. The charts looked smooth. The story looked compelling. But the underlying reality remained fragile, vulnerable to even small shifts in market conditions. Internal concerns had surfaced as early as 1997. Some employees warned that the financial statements were growing more complex, more opaque, and increasingly difficult to reconcile with operational results. These warnings rarely moved beyond private discussions, overshadowed by the company's relentless commitment to growth. The pressure to deliver uninterrupted earnings became a structural force. Any decline risked undermining the market's belief that Enron was a flawless innovator. In response, executives expanded their use of special entities, pushing accounting interpretations to the edges of acceptability, and sometimes beyond. Many analysts relying on top-line figures maintained strong ratings on Enron stock. They praised its leadership. They highlighted its strategic vision. Few interrogated the disconnect between reported earnings and cash flows. Complexity became a shield, discouraging deeper scrutiny. By mid-2001, tension within the company was building. Externally, journalist Bethany McLean publicly posed a question that had lingered beneath the surface. How exactly does Enron make its money? Inside the company, even senior figures were finding that question harder to answer with clarity. In August 2001, Jeffrey Skilling resigned suddenly from the role of CEO, citing personal reasons. Markets reacted with unease. Investors began examining Enron's disclosures with new intensity. For the first time, the company's reputation for invincibility began to fracture. That fracture widened rapidly in October, when Enron announced that it would restate financial statements for multiple years. Hidden debt had to be brought back onto the balance sheet. Earnings had been overstated. Confidence drained from the company in a matter of days. Credit ratings agencies issued downgrades. Trading partners demanded increased collateral. Liquidity evaporated. What had been a slow-forming structural problem transformed into a swift and uncontrollable collapse. On December 2, 2001, Enron filed for bankruptcy. At that moment, it was the largest corporate bankruptcy in US history. Thousands of employees lost their jobs. Many saw their retirement savings disappear because their retirement accounts were concentrated in Enron stock. Arthur Andersen, the firm responsible for Enron's audits, soon faced its own crisis. Investigators discovered that documents related to Enron's audits had been shredded during the period of scrutiny. Although responsibility varied across individuals, the firm as a whole faced consequences so severe that it eventually dissolved. The Enron scandal forced a re-evaluation of corporate governance across the United States. Lawmakers questioned how boards, charged with oversight, had failed to detect the distortions in Enron's financial reporting. Audit committees were criticized for their reliance on assurances from management. Financial analysts faced scrutiny for maintaining optimistic ratings, despite clear signs of inconsistency. A broader question emerged. How had the market rewarded complexity instead of transparency? In 2002, Congress responded with the Sarbanes-Oxley Act. This law imposed strict new requirements on corporate financial reporting. It increased penalties for fraud. It required CEOs and CFOs to personally certify the accuracy of financial statements, placing accountability directly at the executive level. The Act also created the Public Company Accounting Oversight Board, an independent regulator responsible for overseeing the audits of public companies. This was a direct response to the failure of self-regulation in the Enron-Andersen relationship. Internal controls became a central area of focus. Companies were required to document, test and maintain systems designed to ensure reliable financial reporting. Investors gained better visibility into whether a company's numbers were supported by robust internal processes. Beyond regulatory reform, the scandal reshaped cultural expectations. The term off-balance sheet entity became synonymous with hidden risk. Journalists became more attentive to discrepancies between earnings growth and cash flow generation. Business schools adopted Enron as a case study in governance failure. Students examined how incentive structures, corporate culture, and unchecked ambition could combine to produce catastrophic outcomes, even inside seemingly sophisticated companies. The scandal accelerated the development of corporate ethics programs. Companies introduced stronger whistleblower protections, recognizing that early internal warnings could prevent widespread damage if taken seriously. Regulators around the world introduced stricter standards. Countries implemented more rigorous disclosure rules, enhanced auditing requirements and more detailed risk reporting, acknowledging that financial opacity had become a global concern. Analysts began focusing on the quality of earnings rather than sheer volume. They sought to understand whether reported profits were sustainable or merely the product of accounting choices. Cash flow analysis gained importance as a check against manipulated earnings. The Enron collapse exposed the dangers of complexity being used as camouflage. Many of the company's financial structures were legal, but designed in ways that obscured economic reality. Complexity became a tool for concealment rather than clarity. Rating agencies came under scrutiny for maintaining high ratings on Enron debt until shortly before the bankruptcy. Their slow response contributed to investor losses and raised questions about methodologies that relied heavily on management representations. Pension funds and institutional investors re-examined their concentration risks. Many adopted more rigorous due diligence frameworks before allocating capital to companies with unusually complex financial models. Energy markets also felt the impact. Enron had been a dominant player in energy trading, and its collapse disrupted pricing mechanisms in several regions. Regulators revisited the assumptions underpinning energy market structures. The psychological effect on markets was significant. Investors realized that innovation without transparency could mask deeper vulnerabilities. Trust in corporate reporting weakened, contributing to a broader climate of financial caution in the early 2000s. The scandal accelerated the shift toward risk-based auditing. Auditors moved from checking surface-level compliance to understanding business models, incentive systems, and structural vulnerabilities. Academics studied how Enron's culture contributed to the breakdown. The company's internal environment was often described as hyper-competitive, rewarding short-term wins over long-term stability. This culture amplified risk-taking and discouraged dissent. Executive compensation structures came under intense examination. Stock options tied to rising share prices created incentives for executives to maintain an appearance of growth, even when fundamentals weakened. Subsequent corporate failures, such as WorldCom, were re-examined through the lens of Enron. Regulators used lessons from the collapse to identify patterns of manipulation and tighten oversight mechanisms. Enron's bankruptcy remains a watershed moment because it fundamentally reshaped expectations around transparency. It encouraged a lasting skepticism toward financial arrangements that could obscure true economic exposure. Modern forensic accounting owes much to the legacy of Enron. Techniques used today to uncover hidden liabilities, trace ownership structures, and detect earnings manipulation were developed and refined in response to the scandal. Even 2 decades later, Enron continues to influence debates around corporate responsibility. Its shadow persists in discussions of risk culture, ethical leadership, and the obligations of corporations to their investors and employees. In annual reports around the world, detailed descriptions of internal control environments reflect lessons learned from Enron's collapse. Transparency is no longer assumed. It must be demonstrated. As financial systems grow more complex, the fundamental lesson of Enron endures. Innovation without accountability can become a system-wide vulnerability, capable of undermining even the strongest institutions. Enron's downfall was not merely the collapse of a corporation. It revealed a system that had come to reward opacity, speed, and unchecked complexity over substance and sustainability. The scandal exposed how even the most admired companies can hide deep structural weaknesses beneath the appearance of innovation and financial brilliance. It showed that oversight mechanisms must remain skeptical, especially when numbers seem too smooth or too perfect to reflect the uncertainties of real economic activity. In the long arc of financial history, Enron stands as a reminder that transparency is not simply a regulatory requirement. It is a cultural commitment, essential to the integrity of markets and the trust of investors. What other corporate events do you believe reshaped the modern rules of financial oversight?